When you're first starting out in commercial real estate, avoiding big mistakes is a lot more important than trying to hit home runs, and the stakes are really high when you get to these price points. This is true if you're starting out as an analyst and working for a bigger company, but this is especially important if you're investing your own money or raising capital from investors to buy commercial properties. So in this video, I want to walk through 3 things that I personally did not understand the importance of when I first got started in commercial real estate, and why each of these things should be on every investor's radar, regardless of experience level. So the first thing I want to mention here is on the expense side of the equation, and this is changes to property taxes over time. Property taxes are one of the biggest, if not the biggest, operating expense line item for commercial properties, and on top of how big these payments can be, the rules around these can also be extremely complex depending on where the property is located. In the US, every single state has their own unique rules related to when and how a property is reassessed, and these can vary a lot in different parts of the country. Some states will reassess property values every year. Some states will reassess property values only every certain number of years. Some states will have a limit on annual increases of assessed values, and others have no limit on assessed value increases on a year-over-year basis. In California, for example, there's a limit on assessed value increases of just 2% per year if a property isn't sold, which means that even if the market value of the property increased by something like 5% per year over a 10-year period, the annual assessed value increases for tax purposes would still only max out at just 2%. However, as soon as the investor decides to sell, the property would then be reassessed at current market values, which means that property taxes for a buyer can be significantly different than what property taxes have been for a seller within the state of California. Other investors in states like Texas, which reassess property values every year regardless of whether a property is sold, have seen huge assessed value increases over the last 5 years. And because property taxes are often one of the biggest expense line items on a commercial property, major assessed value increases can cause material reductions in net operating incomes, all else being equal. Even in cases where the majority of leases at a property are triple net leases or call for the tenant to reimburse the property owner for their pro rata share of that property tax bill, this can still end up being a major issue since tenants with higher occupancy costs aren't able to pay as much in base rent when their lease is up for renewal, or may even decide to move to another site altogether to avoid these costs. Some commercial leases will also call for a cap on how much a tenant's expense reimbursement obligations can increase on a year-over-year basis, and when this happens, this can also put the responsibility back on the landlord to ultimately make up the difference. The key takeaway here is that in many cases, when you're buying a property taxes will not stay the same as they were for the seller and could change substantially on a year-over-year basis, and commercial real estate investors need to get clear on how these are going to change both when the property trades hands and also during their ownership period. Now, the next thing I want to highlight here is something that I really didn't understand the impact of when I first got started in commercial real estate, and this is lower than anticipated rent growth early on in an investor's hold period. Rent growth compounds over time, so if this ends up being lower than initially projected in the first few years of an investor's ownership period, this can lead to big reductions in net operating income down the line, and this can ultimately have an even bigger negative impact on an investor's exit value when they're finally ready to sell. For example, if we took a look at a sample 10-year investment with assumed rent growth of 5% in year 1, 4% in year 2, and 3% in all years after this, our IRR on the deal would be 12.8% and our equity multiple on the deal would be 2.9x. However, if things didn't go as planned in those first few years of ownership and rents actually stayed flat in years 1 and 2, that IRR would drop down to just 8.5%, and the equity multiple would also drop down to just 2.1x. And even though the drop in cash flow this would trigger isn't ideal, where this really has a negative impact is on the value of the property at sale. And in the first scenario, we can sell the property for $9.9 million at the end of 10 years, but in the second scenario, we can only sell the property for $8.4 million, meaning that those early rent growth hiccups would result in more than a 15% value reduction when the investor exits the deal. The bottom line here is that being overly aggressive on rent growth assumptions early on can cause huge misses in underwriting and really unhappy investors. So being conservative with these from the start can help you avoid a lot of potential headaches that could come up down the line. Now, the last thing I want to bring up in this video that people new to the industry don't always pay as much attention to as they should is the quality of a property's revenue and the credit risk associated with a deal. When I first got started in commercial real estate, my assumption was that if you had a 10-year lease, the income from that lease was virtually guaranteed for that full 10-year period. But even though that might be the case in theory, in practice, things often end up looking a lot different. When you're dealing with businesses and individuals that have incomes that fluctuate over time, you'll sometimes run into situations where a tenant either can't or won't pay you. And when this happens, it can be a lengthy process of negotiation to restructure terms, or you might even have to start from scratch and find a new tenant altogether. On commercial deals, things like tenant bankruptcies and the early termination of a lease do happen, and these things not only lead to lost rent, but in order to release the space and start generating rent again, property owners will often need to pay for leasing commissions and tenant improvement allowances, which can sometimes wipe out entire years of cash flow depending on the size of the suite. This is why investors will typically pay a lot more for a building occupied by Apple or Amazon than an identical building occupied by an unproven startup, because there's a lot more certainty that Apple and Amazon will pay on time and in full every single month, and there won't be a need for the investor to scramble and release the space unexpectedly. The key takeaway here is that just because a property is advertised at a high cap rate doesn't automatically mean that you'll be generating higher cash flows, and the ability and willingness of the tenant base to pay is also something that needs to be looked at very closely before investing in a deal. So if you want to get ahead of your boss as a new analyst, or you're evaluating deals to start your own real estate portfolio, getting clarity on property taxes, being conservative on rent growth assumptions early on, and focusing on tenant credit rather than just projected returns can all help make sure you're minimizing risk and protecting against a downside scenario. And if you want to learn more about real estate investment analysis and the other skills that commercial real estate employers are looking for right now when hiring analysts for their team, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the real estate investment analysis process, make sure to hit the like button and let me know. And if you're watching this and you are an experienced investor or industry professional, let me know in the comments what other things you find new entrants into this business often overlook. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.